Good morning, everyone. Thank you for tuning in to Facebook Live Medicare Monday. I'm Susan Spilly with Indiana Ship, and I am joined by my coworker Megan Rogers. Morning, Megan.
Morning, Susan.
Today's topic is Indiana's Long-Term Care Partnership Program. And with us, we have the director of that program. And Becky Vaughn is going to tell us what is long-term care and what is this thing that Indiana has that's unique to us that has some really great additional benefits to us. And since we are live, you can feel free to ask us questions, ask Becky questions. You can pose them in the chat, the comment section. You can also text Megan and me. But without further ado, thank you, Becky, for joining us this morning. We really appreciate your presence and your information that you're going to share.
All right, thank you. I'm glad to be here. So, yeah, let me just really kind of start in talking about what long-term care is. I think there's some misconception about that. So, I like to kind of maybe point out, think about what we did when we first got up today. We got out of bed, uh, went to the bathroom, took a shower, got dressed, combed our hair, went down, probably made some breakfast, had something to eat, came back up, brushed our teeth. All those, what we call activities of daily living that we don't even give a second thought to until we have some difficulty trying to do them by ourselves. So that's where long term care services come in. It helps us to do those activities either at home or another type of setting called activities of daily living. And maybe there's probably usually two reasons why we can't do those activities. Either we have some physical deterioration, we've had maybe some surgery, so now we're a bit weak and we can't do those things. We've had some broken bones, we're limited in our physical ability, or we might have oops, um, some mental deterioration that prevents us from performing our lifestyle as normal. So that's where long term care services and supports come in. It's different when we think about long term care as compared to Medicare. Medicare, as most of us know, is the medical program for seniors, provides, uh, medical services, doctor visits, hospital stays, medications, and so forth, which is intended, all those things are intended to help us get better. So hopefully there's some positive outcome in that. So that is what Medicare is. Long-term care services are not intended to help us get better, but really just to help us get through those activities, as I mentioned before. And those activities can be performed at home. Someone coming in, help us take a shower because we're kind of weak, help us fix meals, help us get dressed, and so forth. Move from a chair to, get out of a chair with assistance in the bath. So as you can see, it's not really designed to, to help us get better, but just to assist us, where that is where Medicare comes in. The key word there is the care, so it's to get better. Um, so if we're needing these types of services, where can we go to get that help? So a doctor, our personal doctor, would certify that we're needing these types of services, and he would work with the case manager to develop a care plan. You need assistance 3 days a week in the home to help with the bath, get dressed, so forth. So that's where it would start. That it might be in the home, might be an assisted living facility, might be in a specialized unit, all the way up to the highest level of care, which would be a nursing home 24 hours a day. And this care that we might get, it could be a short term thing. Like I say, maybe we've had cancer and we're kind of weak, so we just need some short term, 6 weeks to a month or so. Or it could be an extended period of time as well. So there's a scale of dementia, or not dementia, but level of care when we might need those types of services. So if we do find ourselves needing that type of care, how do we go about paying for that? Because typically there are some care provided by Medicare for those types of services, but it's very limited, very restricted. And usually you need at least requires a prior hospital, 3-day hospital stay, and you need skilled care when you get out for Medicare to pay for that type of care. So if that doesn't occur, then you're just needing long-term care, so you would have to pay your own money to have someone come in and provide that service, or you could depend on your family or friends to help you provide that care as well. Um, Also, another government program besides Medicare is Medicaid, which is actually the largest payer of long-term care type of services. So you could apply to Medicaid for that type of care. Medicaid is a program designed for the low income individuals. So if you're not at that level, you would have to qualify to get Medicaid services, and Medicaid would look at both your assets and income to qualify for those types of services from Medicaid. Another way you could get long-term care services is just like we do for our homeowners, our auto policies, is to get an insurance policy and to go out to the market and purchase a long-term care type of policy. So when we're talking about long-term care policies, there's different kinds. There's what I would call a traditional policy that would pay for in-home care, nursing home, assisted living, and that's all it pays for is that type of service. Then there's the trend now is to get long-term care is through what we call a hybrid policy. You might have a life insurance policy that has long-term care benefits tacked onto it. So it's a combination of benefits. So that's called a hybrid policy. Or you might have strictly a life or annuity policy that just has long-term care riders attached to it. So there's pros and cons for all those types of policies. Just like anything, there's pros and cons. So if you're looking for that type of policy, I would suggest going out to the internet, looking up, the highest rated long-term care carriers. You would certainly want to look for something that has an A rating in the financial aspect of that, because not all companies write long-term care, and we're getting fewer and fewer companies that do write long-term care, but there still are some companies out there as well. And one of the if you do go the route of getting a long-term care policy, there's some basically about four main features that you would want to look at. One is the how much it would pay per day if you're in a nursing home or per month. So let's say you pick a policy that's going to pay $200 per day. So the policy would pay whatever your charge is for a nursing home up to, let's say, $200. If the charge is only 180, the policy is going to pay $180. If the charge is 220 and your policy limit is $200 a day, then you would have to pay the extra anything over $200 a day. Then you're going to pick a benefit period, which could be 3 years, 4 years, and this is really just a math factor. It doesn't mean that if you picked a policy that paid $200 a day for 4 years, and you start using benefits and you used it for 4 years, then you're done. It's really a math factor to get to your total benefit pool. So let's say you did pick a policy that paid $200 a day for 4 years. So you would take your $200, multiply that times 365 days in a year times 4, and then you would come up with a lifetime benefit, a pot of money. So whenever you had long-term care services, out of that pot of money, those services would be paid. If the benefits they paid were less than your maximum per day, they would still remain in your pot. So if the only your charge was $150 a day, but your maximum was 200, your policy benefits could last longer than 4 days. So kind of think a big misconception on that. If you pick a benefit period, let's say of four years, and you think that you might be done after 4 years. No, it's just a math factor to determine your pot of money. How long that pot of money lasts is the key factor. Another thing that you would want to look at when you're picking benefits in your long-term care policy is an elimination period. Just like we have a deductible with our car insurance, our homeowners, our health insurance, you have an elimination period. And that's how many days that you qualify for receiving long term care benefits that you're paying for out of your pocket before the policy kicks in. Obviously, the longer your elimination period, um, the less it's going to um, cost you because you're paying out of your pocket in premium, less in premium that you're going to pay. So elimination period is the number of days you're paying out of your pocket for services before the policy itself would kick in and start paying. Another important feature in a long-term care policy is the inflation factor. So that is a factor that increases your benefits automatically. So if you picked a $200 a day benefit, um, you would want inflation factor in there. So like next year, instead of 200, your policy automatically would, let's say, jump to 205 if it paid 205. So it's an important feature to keep your policy benefits up with the cost of care. Inflation does add premium cost, but I think you would want a policy because hopefully you would never need your policy, but hopefully if you got it, you would need it for 20, 30 years. So you would want your policy benefits to continue to grow to keep up with the cost of inflation. So those four factors, your daily benefit, your benefit period, the elimination, and the inflation factor are all important features when you're looking at a long-term care policy. A long-term care policy is good anywhere you go in the United States. So if you purchased it in Indiana, you moved to Florida, you have a legal contract, so your benefits would still be good in Florida. The the price of a long-term care policy is based on the age that you are when you purchase it, your health status, the benefits you choose, and the insurance company. If you're looking for a long-term care policy, you would want to look at two or three different companies and compare rates and benefits as well. The rates for a female are higher than for a male because typically females live longer than males. And so, the insurance company could possibly be on the risk longer as well. It's a good thing that we're living longer, but it does, on the cost side, it does cost us a little bit more. And also, the insurance companies do look pretty heavily at your health, your current health, as well as your health history. So they're trying to predict 20, 30 years down the road, are you going to be needing these benefits? So they're looking at particularly, are you experiencing any dementia right now, any loss of memory? That is a key indicator. And do you have any dementia in your family, any Alzheimer's? So that's something that they're really keen on. Also, mobility. So, dementia and mobility are the key factors that the insurance company look at when they're determining rates for a long term care policy. Are you having issues now with mobility issues? So, other health issues, just because you've had maybe cancer in the past, asthma, heart attack, that doesn't necessarily mean that you're excluded from getting a policy. They look at other factors. Are you being treated for that? Or do you have other underlying factors? Do you have high cholesterol, but you're not being treated for that? So that all goes into when they set the rates for a long term care policy. When we're speaking about rates, When they rate these policies, the expectation is that they will not have to raise rates, but it's not guaranteed. So just keep that in mind. On the policy, it will say a long term care policy is guaranteed renewable. What that means is that as long as you pay premiums, the insurance company cannot terminate your coverage. It does not mean that the rates are guaranteed. So, an insurance company, if they want a rate increase, they have to file it with the Department of Insurance. And then we have two actuaries and the commissioner that review all that information and determine whether we think a rate increase is justified. We can either approve what they ask for, disapprove it, or offer an alternate amount. So those are the choices that the routes that we can go. So we really are scrutinize those rate increases because we understand the impact to a policyholder to get a rate increase as well. So you cannot get more than one rate increase in a 12-month period, but it is subject to rate increases. Um, if you if you're a ship counselor and you're talking to a client and they've gotten a letter about a rate increase, feel free to have them call me. There's in the rate increase letters, they will give a policyholder certain options. You can take this action if you want to reduce your rate increase. There's other options available. They can't put everything in the letter. So I'm very willing to talk to a policyholder and explain some of the different options that may not be in the letter and just really how that impacts their policy benefits as well. So don't hesitate, even if you're just a consumer, to give me a call and I'll be glad to talk to you about a rate increase as well. Um, Susan mentioned partnership policies. Those are a special kind of policy. It's a traditional policy, pays for all the same things like home health care, assisted living, nursing home, but they do have some special benefits added in them that are not available in a traditional policy. And one of these benefits is called asset protection. So let's say in the event that you do have a long term care policy and you use all your benefits up. So then we go back to, okay, how are you going to continue paying for it? Either you'd have to pay out your pocket or rely on your family to pay for it. Medicaid is very limited in what they might pay. So your only option may be to apply to Medicaid. When you apply to Medicaid, Medicaid looks at your assets and your income to determine if you're eligible for Medicaid. If you have too much in assets or income over what the limits they set, then you have to spend down, somehow get rid of those assets to qualify for Medicaid. However, if you have a partnership policy, one of the nice features about a partnership policy is that it allows you to keep more in assets and still qualify for Medicaid without having to spend down your assets. Um, it doesn't have anything to do with how much Medicaid will pay if you become a Medicaid beneficiary, only on the when they determine whether you're eligible for Medicaid or not. So let's say I I'm $50,000 over what Medicaid says I can have to qualify in assets for Medicaid. If I did not have a partnership policy, I would somehow have to spend or dispose of that extra to qualify. But if I had a partnership policy, I would get to keep that extra 50,000 and still qualify for Medicaid. And the nice thing about it is that in the partnership policy, there's no added cost for asset protection. It's a freebie. It's really kind of a thank you from the state for saying, hey, we're glad you purchased this partnership policy. Hopefully, you'll never need it. But in the event that you do use all your benefits up and decide to apply to Medicaid, you get to keep more of your assets and still qualify for Medicaid benefits. So let me take a quick drink here. in Indiana is kind of unique in that we have two kinds of asset protection. One is called dollar for dollar, and the other one is called total asset. And the difference is how much asset protection you would get to keep if you did apply to Medicaid. If you have a dollar for dollar asset policy, and the policy, let's say, paid out $300,000 in benefits, when you apply to Medicaid, you get to keep an extra $300,000 in assets and still qualify for Medicaid. If you had a total asset policy, it doesn't make any difference how much the policy had paid out in benefits. All of your assets would be exempt from Medicaid spend down. So you would get to keep all of your assets and still qualify for Medicaid. Also, a partnership policy um, on the back end. So if you do apply to Medicaid, Medicaid is required by the federal government to go back to your estate um, and try to recoup any monies they have paid out on your behalf. But if you have a partnership policy, not only do you get more favorable treatment applying to Medicaid, but also on the back end, partnership policies are exempt from Medicaid estate recovery. So another nice feature for or partnership policies. Also, with partnership policies, um, you do can get a state tax, Indiana state tax deduction for the premiums that you paid for a partnership policy. Um, there's also something with partnership called reciprocity. Like I said, if you have a long-term care policy, you can go to any state and the benefits are paid. Also, if you have a partnership policy, you could, let's say have an Indiana partnership policy, you retire to Florida, you use all your policy benefits up, you decide to apply to Medicaid. If you're in Florida, you can apply to Florida Medicaid, and they said, okay, you have a partnership from Indiana. We will honor your partnership policy on a dollar for dollar basis. If you had a total asset policy from Indiana, the only way you could have all of your assets disregarded would be to move back to Indiana and apply to Indiana Medicaid to have all of your assets protected. Otherwise, moving from one partnership to another would provide you with asset protection on a dollar for dollar basis. So that's let's see here. That's pretty much my remarks. Do we have any questions?
Yeah, Becky, I do have a question. When you say a policy pays out, depending on the policy, say you have a policy that pays $200 a day for in-home care. Does that payment go to the policyholder or does the payment go to the provider of services?
That's a good question. Um, if the facility will accept assignment, then the payment would go to the facility. But typically, the payment goes to the policyholder and then you pay the bill.
Okay. And so that is not treated as income, right?
Correct. That is
Okay.
not treated as income.
Okay.
Yes. 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 So. A
Oh,
lot of times people want to know, like how much a long-term care policy would cost. Here again, that's, kind of depends on your age, your sex, the company you choose, and the benefits you choose. But typically, when someone's looking for a long-term care policy, they're usually in their 60s. Typically, right now, you're usually going to get like a 90-day elimination period, probably like 200 to $250 per day, and usually a 4-year benefit period. So just ballparking premium wise, we're probably talking around $3,000 a year for a long-term care policy. Of course, if you did not have a policy and you needed benefits, um, just for home health care itself is $300 to $500 a week. A nursing home, typically on a year, is about $140,000 a year for a nursing home in Indiana. So,
And age is not a factor in when you use your benefits, right? So if you bought a long-term care policy at age 60, and then, and you were thinking you're in it for the long haul, to use it when you reach older age, but something happens and you need services at age 61, then you can still use it. There's no age quotient in there.
right, age is not a factor when you're needing benefits. Age is only a factor at the upfront determining the premium that you're going to pay.
Okay, great.
Yes.
Megan, did you have any questions?
Yes, I do. I have a couple that were texted to me. Um, you may have already answered this, Becky, but I want to make sure the individual knows the answer. Can you change your benefit period or the types of benefits that you have, like the length of the benefits, after you already have a policy for one set of benefits?
You can change. Typically, they don't let you um, go down.
Okay.
I mean, typically they don't let you increase it. They will let you go down,
Oh,
decrease it,
okay.
but not up it, because they have set those rates predicted on this is what we, you know, if we had to pay out, this is the level that
Mhm.
we expected. But they do allow downgrades.
Okay.
Yes. And that's a good question because sometimes, you've had this maybe for 20 years. So your thinking is a little bit different. Okay. You're thinking, okay, I don't maybe need that much of a
Mhm.
benefit. I have a pretty good handle. I think I'm in fairly good health. I've got some other resources that I might use. At the time I bought this, I didn't. So I might not need that rich of a benefit. I'm 80 now. You know, if I start needing services, I don't think I'm going to need it for 20
Mhm.
years. So, yeah, so you can downgrade, but not typically. And if you did downgrade, you cannot go back up again. So,
Okay, that's
yes,
good to
good
know. Thank
good
you.
question.
Yeah. One other question that came in is they don't know if they have a partnership policy. How would a person know in the paperwork that they have from the insurance company if it is a partnership plan?
Okay, there's three places that are predominantly in your paperwork. So on your policy, about the first page, there will be this paragraph. It's boxed in and it's in bold. It'll say this policy qualifies or does not qualify for Medicaid asset protection. It doesn't say partnership, but it says Medicaid asset protection. So that paragraph will be on your policy. It will be on the outline of coverage and it will be on the application as well. So you can check there. If you don't have your policy, I do keep a database of those policies. So, I can help you out there. I would
Wonderful.
say call the insurance company, but a lot of times I have found that the insurance company tends to refer those people back to me. Um, so you could start there. But yeah, certainly look for that identifying language on those three documents or give me a call.
Okay. And what number can individuals reach you at?
My direct number is 317 232 2187. And we have a toll free number, which is 866. Hold on one second. I don't
You're
recall
fine.
that. 866 234 4582.
Perfect.
And
Thank
then on the Department of Insurance website, you can go on there, and then over on the left-hand side will be a long-term care, and you can click on there as well.
And
you.
that website is
Um,
www.idoi.in.gov.
it's www.in/idoi.gov.
Thank you.
And I'll get this all on our chat box here.
Thank you, Megan.
You're welcome.
I have no other questions and there are no more in the chat. Megan, are you, did you get any more questions?
No, I did not.
Okay.
Okay,
Well, Becky, thank you very much for
thank
joining
you.
us, and Megan's going to wrap us up here in a minute.
Anytime. Thank you.
Yes, thank you, Becky, for joining us. Let me share my slides here real quick and I will share what's coming up. So we have one more live left in April. We are going to be back here on the 28th with Juan Manuel, who is going to present in Spanish the Medicare savings programs and extra help information to individuals. So if you know someone that speaks Spanish, please let them know about this Facebook Live coming up. It will be very informative. And then in May, we have two Facebook Lives that I'm very excited about. On May the 12th, we will have preventative health for women. So following Mother's Day, we are going to talk about ways that women can get some good preventative health and make sure they're healthy. And then on the 14th, we will be back and you can ask the expert. Susan and I will be your experts for the morning, and you can share your Medicare questions and see if you can trump us and see if we know the answers. So that's what we have coming up. Thank you everyone for joining us this morning. Our Facebook Lives will be saved on our feed for a while, and then you can also go to our YouTube page, and they are always on our YouTube page. We do kind of take them off like after a year or so, you know, if the information is outdated, but you can find most of our videos either on YouTube or our Facebook page. So thank you again, and we will see you back here on the 28th.
Bye-bye.